Hello, everybody, and welcome to the Trading with Ashley show. I've got something really exciting to share with you that's going to help you make a lot of money this week on premiums from selling puts. We're talking about Nvda earnings. Now, Nvda earnings are Wednesday after the bell, so you're going to have a few days on Tuesday and Wednesday to take this play. And I think the IV is going to go up even more than what I'm looking at right now, which is going to make it great for you and probably make it even more profitable than what I'm showing you. So what I'm going to show you is going to be over a 60% return. Now, we're going to be in and out of this trade in a few weeks, and I'm going to break it down for you so that you can fully understand how to manipulate the dynamics with options and volatility to stack the odds in your favor. Now, I do this all week long with my students, and they're so excited. They're making such great money. As you can see, we have a couple of students that she made almost $5,000 in 1 week after joining. Another was able to make over $20,000 once she knew how to properly sell options. And she did not know anything about selling options before she went through my boot camp. Now, I don't currently have a boot camp running right now, but I will be announcing one soon. And those in my Discord community, they are the ones that are going to get the first opportunity to jump in on those spots. But if you're interested in just learning my style, I am teaming up for a workshop with Stocks with Josh. He's a friend of mine. He has a very successful YouTube channel, and he goes through technical analysis quite a bit, looking at some of our favorite plays. I have come up with a trademark trading strategy called the skip call option, and he loves to trade it in his community as well. So we are going to marry his technical analysis with my trading strategy, and we are going to show you how you can use this to actually profit quite a bit over the next year. What if one workshop could change the way you trade forever? Josh and I are hosting a live 2-hour workshop where I'll be teaching you all things skips. A smarter, lower risk option strategy I actually developed and trademarked to help you grow your portfolio without gambling.
And I'll be diving into charting mastery from indicators that work to how to spot trend reversals before they happen.
It's all happening Saturday, May the 31st at 6 p.m. EST, and spots are limited.
Click the link below to secure your spot and thank us later when you turn your trades into a Wall Street ATM.
Trust us, your future self will thank you. Now, that event is going to be on Saturday, May the 31st, and spots are limited. So click the link below. It'll be the first ones that you can join us for the workshop. Okay, let's go into the computer, and I'm going to show you everything you need to know to trade Nvda earnings this week. When you're going to trade over earnings, the first thing I like to do is let's take a look at the expected move after earnings. So Nvda, if you look at the put-call ratio, then we want to consider that it will potentially move anywhere between 6.64% and 10% in either direction. So if you're looking at dollars and cents, that's anywhere between about $9 and $13 up or down. So we're selling a put, so we want to consider how much it may potentially pull back. So if you're looking at that, you're considering maybe around $118 it will potentially pull back to. So now let's go look at the technicals and see where $118 lines up from a technical analysis standpoint. If you look at Nvda on the 3-month chart, I am on Yahoo Finance. I have some of the important moving averages populated. And so if you look at this, the 3-month chart, 118 is about right here. It's in between two very important moving averages. First, you have the 20-day moving average, which is sitting right here at about 122. It's the middle of my Bollinger Band. But you see this yellow line right here? This is around $115. This is the 50-day moving average, and that's an important level for a stock. So if you consider 118, it's right there in the middle of those. You could go with 118, but for this trade, I am going to stick with right here about 115. So I'm going to go below the expected move to sell my put. When you get to the option chain, we need to select an expiration date. For my first example, I want to, at least for comparison purposes, look at something around 2 weeks out. You don't want to go right after earnings because you need to allow the stock to oscillate up and down. So let's take a look right here at 6/13. If we want to stick with that $115 mark and we go with 613, we can see right here it's paying about $1.54 a share. So what this means is if we put up the $11,500 for this trade, we're going to get $154 in a matter of a couple of weeks. Well, that's nice, but when you annualize that, it's not significant. Let's do the math. To annualize this return, what we would do is take the $1.54, what we're receiving, and we would divide it by the $115 a share. That equals 0.013. You multiply that by 100, and now we're looking at about 1.33% in a matter of a couple of weeks. Well, if you consider we have 52 weeks in a year, what you want to do to annualize this is multiply it by 26. So once done, that equals about 34% a year. So much better than just putting it in the S&P, but what I'm about to show you is going to offer you even more. Now, what I'm going to do to adjust this trade and make it more profitable, I'm going to go out to August. So I've played with a few of the figures, and this is the one that offers the best opportunity for us. So if you go out to August, and let's go back to that 115 strike price. Okay, so now we're going to actually get a lot more to sell the 115 strike. If we go out to August, we're going to get actually $4.72 a share. So that's $472. So on the face value, that's great, but you may be concerned because you're thinking, okay, now I have to tie up my money all the way till August. Well, not necessarily. This is where the elevated IV in earnings actually helps us quite a bit. So if you remember that other trade, we were going to get about $150 in a couple of weeks. So what I want to do when I'm doing this, I want to look at this figure and divide it by 2. And I want to consider after the IV crush takes place, if I could get 50% of what this is offering by buying the contract back, will I be ahead of that $1.50? And yes, you would. What I'm going to do now is we're going to look at the IV crush that takes place as a part of Nvda earnings, and then you're going to see why this trade is more lucrative, and we will more than likely be able to get out in a couple of weeks, and we'll be able to hold on to about 50% of this value. We are going to look at Nvda earnings dates. They go from May of 2024 all the way to February of 2025. And let's see what happened before and after earnings. Here, I have it all laid out for you. So let's take a look at what we're looking at. Right now, we're looking at May the 22nd. Prior to earnings, Nvda was trading at about almost $95. And then after earnings, it went up 9.32%. The price after earnings was 103, and then 2 weeks later, it actually exceeded that. It went up to 123. IV prior to earnings was at 75, but then after IV crush took place a couple of weeks after, it went down by 40% and it was sitting at 45. Let's look at a few other dates. If you look at the August 28th earnings date, it was sitting at 128 prior to earnings, and it actually went down after earnings. This is what happens with Nvidia when it's trading at the top of its Bollinger Band. And if you look at that, it was down 6%. So the price went down to 120, and then a few weeks later, it was really kind of flat right there at about 119. But what's impressive here is that IV. So we were at 70 prior to earnings, and then after earnings, we saw IV crush of about 28%. It went down to 50. Looking at November, let's take a look. 148 before earnings. After earnings, it went down just a bit, about 0.53%. And then 2 weeks later, we were down a little at 138. But again, let's look at IV crush. So we were very high on IV. At that point, it was 111. It went down by 50% 2 weeks later, and it was sitting at 55. And now our latest earnings, we have right here February of 2025. It was at 126 prior. It went down 4.48% after, settled in at 120. 2 weeks later, it was back up to 134. IV crush took place. We had 60 prior. It went down about 16%, and then we were sitting at 50. And the reason this is important is because you're an option seller, you're going to get more money when IV is high, and then you're able to buy the contract back when IV crush takes place, and you're able to buy it back for a cheaper price. Now, movement of the stock price has something to do with it as well. So let's go look at an option calculator and see if it's realistic that we could actually get out of this trade that I just showed you, the August trade, for about 50% a couple of weeks after earnings. When we put this on our option calculator, it's the August 15th date, it's the 115 strike. We will be receiving about 470 for the trade. But what I want to bring your attention to is the implied volatility. So right now we're at about 48%, and this will probably go up even more as the excitement for earnings builds on Tuesday and then even Wednesday prior to earnings. But if you're looking at this right now, if you slide this bar down to more than likely the Ivy crush that will take place, and more than likely it'll get us down to about 36% a couple of weeks after based on past performance. So as I slide this down, you can start to get a clearer picture of what's happening. So you received 470 for the trade initially. But let's go back to that June date, mid-June, okay? This was the original trade, and then we went to August. If we decide to get out of this trade, and let's say Nvidia just kind of hangs out where it is right now, around the 131, or even if it goes up slightly and settles in about 136. Look, it's a lot more than 150 that we're able to keep. At this point, we're able to keep 285 if it stays flat to where it is now a few weeks later. And then as it rises up, look how much money we get to keep. $353. If it gets up to 140, we almost get to keep $400 of the 470 we received. So now let's look at the return on this amount of money after a couple of weeks. So let's be conservative and go with 285. And look, even if it draws down, you still get more than you would if you went with that trade that was just a few weeks out. You would get 186 here, even if Nvidia pulls back to 126 2 weeks post earnings. But realistically, I think staying stagnant might be something that plays out. So let's look at the 285. So you take 285 and then you divide it by the 11,500 that's being held for the trade. That equals 0.0247. So you multiply that by 100. Now we're looking at 2.47%. Again, this is after only 2 weeks, so you multiply that by 26. Now we're looking at a 64% return. So we did significantly better by going just a little bit further out on this trade. I hope you found that helpful. Now, if everything I shared with you was a little bit confusing and you just want to look at going back to basics and better understanding how to even sell a put option, I worked on a video the other day that is very helpful for new members, and I'm going to leave that video for you here at the end. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Here's that video I promised.